Welcome to Talk Tickers. It is Saturday, January 17th, 2026. Usually we're here breaking down the latest quarterly earnings prints or, dissecting guidance from the Fortune 500. But today, we're taking a step back. We're looking at the market mechanism itself, the engine that drives every single trade you place.
That's right. Today isn't about what you're buying, but how you're buying it. We're digging into the hidden plumbing of execution quality.
It's a topic that sounds incredibly dry. Execution quality, until you realize it determines exactly how much money is silently, leaking out of your portfolio every time you hit that green buy button. We're talking about the fully implemented amendments to SEC Rule 605, the economics of payment for order flow, and what the data is finally telling us about the true price of free trading. It really comes down to that classic economic reality. There's just no such thing as free lunch. I mean, for years now, we've all been in the zero commission world.
Right.
You buy a share, the transaction fee is zero. But the revenue for the brokers, it didn't just evaporate, it shifted. It moved from explicit fees to implicit execution costs.
Yeah.
The costs went underground. And for the longest time, the flashlight we had to find those costs was pretty dim. But as of late 2025, the SEC's overhaul of Rule 605 is fully in effect. So we have new data, new requirements, and frankly, a new reality for measuring trade quality. So our mission for this deep dive is to unpack these new requirements. We need to understand what this flood of new reporting actually reveals about the price we all pay.
And maybe more importantly, figure out how to tell the difference between a broker that's routing for your benefit versus one that's routing for their own revenue, because now we can actually measure it.
Let's start with the results snapshot. What's the headline here? Because Rule 605, it isn't technically new, is it?
No, it's been around. But the old version was, let's just say, a dinosaur. It was built for a market dominated by guys shouting in a pit, not for algorithms and smartphones.
Okay.
The core update, adopted back in March 2024 and now fully implemented, it forces large broker-dealers to disclose really detailed execution quality stats.
And when we say large, who are we talking about?
Specifically, brokers with more than 100,000 customers. Before, it was mostly the market centers, the exchanges, the wholesalers who had to report this. Now, the retail brokers themselves, the Robinhoods, the Schwabs, they have to show their hand.
That feels like a huge shift in accountability. Before they could sort of point to the wholesaler and say, well, that's the data they gave us. Yeah. Now they have to own the stats.
Exactly. And they have to show it in a standardized format. So we're seeing metrics that were, hidden or very hard to calculate. The big one to watch, and we'll break this down, is EQ, effective over quoted spread.
We're definitely going to get into the math of that, but basically that's a scorecard of how much the bid-ask spread you're actually paying.
Precisely. But the report also demands data on size improvement, meaning did they fill an order larger than what was on the screen? And critically, odd lot data.
Okay, I want to pause on the odd lots. This seems like the area where the average investor has just been flying completely blind. For years, if you traded less than 100 shares, you were basically a ghost in the machine, right?
You were invisible, at least to the official metrics. Now, orders under 100 shares are included. And considering that odd lots make up this massive portion of retail volume, leaving them out was just absurd.
It's like trying to track inflation, but ignoring the price of food and gas.
It's a perfect analogy.
So the shift is that we finally have an apples-to-apples comparison. We can look at broker A and broker B and see who's actually getting better prices, not just who has the better Super Bowl commercial.
That is the goal. Transparency drives competition. If you can see that broker A consistently gives you a worse EQ than broker B, well, market forces should push broker A to get better.
To really appreciate why this matters, I think we have to look at the history here. Because the road to 2026 has been paved with a lot of changing incentives. Go back to the 80s. A trade was an event.
Oh, yeah. You called a guy, you probably paid $200 for the privilege.
It was a luxury service.
Absolutely. Then the 90s brought it down to maybe $40. But the real revolution and the root of our current situation was that zero commission war started by Robinhood.
And then all the big guys, Schwab, TD, Ameritrade, they all had to follow.
They had no choice.
But let's be cynical for a second. They aren't charities. How did the business model survive with zero revenue on trades? Well, the revenue didn't hit zero. It just moved. It shifted heavily toward two things. Interest on your cash balances and payment for order flow, PFOF.
Wholesalers firms like Citadel Securities or Virtua paying the broker for the right to execute your order.
And this is where that odd lot problem we mentioned became such a critical loophole. The National Best Bid and Offer, the NBBO. It only cared about round lots of 100 shares. Why was that the standard?
It's a legacy of the physical paper era, a holdover. Stocks used to be traded in certificates of 100. It was just efficient for the guys on the floor. In a digital world, it's a totally arbitrary cutoff.
So until recently, if I put in an order for 5 shares of, say, Amazon, that order wasn't protected by the same rules as a 100-share order.
Right. It didn't impact the NBBO. And before these new rules, data showed odd lots were over half of all equity trades. It was a black hole. And because they were hidden from the tape, retail orders often got worse pricing.
So the wholesalers were potentially giving worse prices to the little guy because their trades didn't officially register on the scoreboard.
That's the implication. And look, it wasn't just a U.S. issue. The UK actually banned PFOF way back in 2012. There was a CFA Institute study that looked at what happened after.
What did they find? Because the argument here has always been that PFOF lowers costs for everybody.
Right, that's the defense. But the study found that after the ban, the proportion of retail trades executing at the best quoted price, it rose from 65% to over 90%.
Wait, wow, that is a massive jump. That suggests conflict of interest in PFOF was actually degrading execution quality? A lot.
It certainly points that way. And spreads on large cap stocks in the UK narrowed too. But here in the US, the real catalyst for this overhaul, it wasn't academic studies. It was the GameStop saga in 2021.
That was the moment the curtain got pulled back. You had these, gamified apps with confetti on the front end, but on the back end, you had this complex settlement machinery that just couldn't keep up.
It exposed the gap between the user experience and the market plumbing. That led to the move to T+1 settlement in 2024, and it set the stage for this focus on pricing efficiency.
Okay, let's unpack the mechanics. We keep saying PFOF, but how does the money actually move? I place an order on my phone for 50 shares of some stock. Where does it go?
So you tap buy. Your broker, let's call him Broker X, they don't usually send that order to the New York Stock Exchange. They send it to a wholesaler. The wholesaler is a market maker. They internalize the trade.
Meaning they match it against their own inventory. They aren't going out to find a seller for me.
Exactly. If you're buying, they are selling to you from their inventory. The wholesaler earns the spread, that little difference between the bid and the ask.
But why do they want my order specifically? Why are they paying Broker X for my little 50-share trade?
Because retail flow is generally considered uninformed.
That sounds a little insulting.
It's a technical term. It just means you probably aren't a high-frequency hedge fund that's about to move the market. It's safe, profitable flow for them. They know the price isn't likely to move against them a second after they trade with you.
So they take that profit from this spread and kick a piece of it back to my broker. That's the payment for order flow.
And that is the conflict of interest. Your broker has a legal duty of best execution. They're supposed to get you the best possible price, but they're also getting paid to route your order to a specific wholesaler.
It feels like a doctor getting a kickback for prescribing a certain drug. The drug might work, but is it the best one? Or just the one that pays the doctor?
That's the analogy people use. And the SEC has found cases, like with Robinhood years ago, where orders executed at inferior prices cost customers way more than they saved on commissions, like $5 to $15 per order on bigger trades. So you save the $5 commission, but you overpay for the stock by $10. You're net negative, but you feel good because the receipt says commission free. Exactly. It's a psychological trick as much as a financial one.
However, I do want to play devil's advocate. The wholesalers, firms like Virtu, they argue that they provide a better service. They call it real price improvement. Is there merit to that?
There is. Specifically regarding size improvement, their defense is that the old Rule 605 metrics ignore that they often fill large orders without moving the price.
Can you walk us through an example of that?
Sure. Let's say there are only 100 shares available at the best price on the exchange, but you want to buy 500 shares. If you went to the exchange, you'd buy those 100, and then you'd have to buy the next 400 at a higher price.
You'd walk the book and get a worse average price.
Right. But the wholesaler says, don't worry, I'll fill all 500 at that best price. They commit their own capital. They argue that if you just look at the quote, you miss the value they provide in liquidity. And for big orders, that's a real benefit.
This brings us to the jargon section, because these new reports force us to distinguish between two types of spreads. And I really want to nail this down. We have effective spread and realized spread. What's the difference?
Okay, let's simplify. Effective spread is what you, the investor, actually pay. It's the difference between your trade price and the midpoint of the market when your order hit.
So if the stock's midpoint is $100 and I buy at 101 cents, my effective spread is 1 cent. That's my cost.
Right. You want that number as low as possible.
Wow.
Now, realized spread is a metric for the market maker's profit. It measures the difference between your execution price and where the market price is after a certain amount of time.
So it measures if the market moved against them or for them after the trade happened.
Exactly. It measures adverse selection. If the realized spread is high, it means the market didn't move much, and the market maker just pocketed a fat profit.
So let me see if I've got this. If I look at a broker's report and I see a high realized spread combined with a poor, meaning high effective spread for me.
That's the red flag. That's the smoking gun. It suggests the market maker is profiting heavily at the investor's expense on a trade that wasn't risky for them.
That is fascinating. It basically lets us see the profit margins of the middlemen on our trades. It's like seeing the dealer invoice on a car.
And it connects right back to why this all matters in 2026. With these reports, you don't just have to trust the marketing. You can see who's prioritizing price improvement versus who's routing for PFOF revenue.
I also want to touch on the tick size update, the move to half-penny increments for some stocks. What does that solve?
It helps stocks that are tick constrained. Think of a really liquid stock. It wants to trade with a spread of maybe half a penny. But the old rules only allowed penny increments, so the spread had to be wider than it needed to be.
So the investor was forced to overpay because the system just couldn't handle the precision.
Right. The move to half pennies allows for better pricing. If the spread narrows by half a cent, that is a direct saving to you on every single share.
Now, I can hear a listener thinking, okay, this is interesting, but I trade small amounts. Does saving a penny here or there really matter? It absolutely matters. We call it the hidden tax. Think about it. Buying at $100.05 when the midpoint is $100 costs you 5 cents a share.
If you're an active trader, doing that hundreds of times a year, or if you're moving larger blocks, that drag adds up to thousands of dollars over time.
It's like an expense ratio on an ETF. You don't get a bill for it, but it just eats away at your returns year after year.
Exactly. And this matters when you're deciding between accounts. A premium account might charge a $5 commission but save you $20 on the spread. You have to do the math now.
So let's get practical. When we look at this new data, what are the specific things we should be hunting for?
The first one is the EQ ratio. That's effective over quoted spread.
How do I read that?
It's a percentage. If a broker's EQ is 100, their customers are paying the full quoted spread. If it's higher than 100, they're paying more than the spread. Which is terrible. You want to see an EQ well below 100. That shows you're getting price improvement.
So if broker A has an EQ of 85 and broker B has 98, broker A is saving me money.
On average, yes. Broker A is capturing more of that spread for you.
And what about limit orders? A lot of people don't use market orders.
For limit orders, you look for fill rates. Specifically for non-marketable limit orders. Is your limit order actually getting picked up, or is it being ignored because it isn't profitable for the wholesaler?
I've noticed that myself. You place a limit order at the bid, and it just sits there while trades happen all around it.
That's often a routing issue. The new data exposes those fill rates so you can see which brokers are better at getting those orders filled.
This brings us to the one question. If you want to cut through all the noise and evaluate your broker, what is the single question you need to find the answer to? The question is this. What is my broker's average effective over quoted spread, or EQ, for my typical order size? Why is typical order size the key part of that?
Because the data is broken down by size. A broker might have great execution for 100 share lots, but terrible execution for 10 share lots. You have to look at the bucket that matches how you trade.
And why EQ specifically?
Because it strips away all the marketing of zero commissions. It tells you, as a percentage, how much of the bid-ask spread you're actually paying. It is the single truest measure of the price of your trade.
What is my broker's EQ? I love that. It turns a vague idea into a hard number.
It's quantifiable accountability. And as we wrap up here, we're really seeing the era of opaque execution closing. The U.S. has chosen a path of sunlight disclosure and competition, while other places like the UK, EU, Australia have moved toward outright bans on PFOF.
It's a divergence in philosophy, isn't it? We're not banning the practice, but we're handing investors the data to police it themselves.
Exactly. Odd lots are no longer invisible. PFOF is still a contentious mechanism, but at least now we can all measure the cost.
The free trade is an illusion. The cost is just buried in the microseconds and the spread. But now, thanks to these updates, you finally have the flashlight to go find it.
That's the key. Use the flashlight.
That does it for this deep dive into execution quality. Thank you for listening to Talk Tickers. We will be back next time to break down the numbers that matter most to your money.